Hello, everybody, and welcome to our webinar today. I'm David Perlmutter from Quantum Listing, and we are very lucky to have Todd Hess, a managing director at KW Commercial in Texas, to be our guest presenter today, and he is going to tell us how to double your business by using SBA lending. Let me tell you a little bit about Todd first. Todd has a bachelor's degree from San Diego State, where he played baseball, and he's got a lifetime teaching credential and master's in education from USC. He taught school and coached football and baseball for 10 years at Orange High School in Orange County, California, and during that time he acquired his administrative credential from University of California at Irvine. He started his real estate career in 1979 at Valentine and Associates, and 5 years later was the co-owner of the company. He's also formed public land consultants to advise school districts on their excess land, and worked with Occidental and Research through its bankruptcy. During this time, Todd invested in vision art design and animation, and shortly thereafter became the president of Santa Monica Studios and Vision Art. Under Todd's management, the company grew to 250 employees, and they worked on films such as Independence Day, Dr. Dolittle, and Godzilla. After the company was sold, he returned to commercial real estate at Beitler Commercial as a vice president of acquisitions, and Todd has done real estate transactions in over 20 states worth over $500 million, and has got vast experience in all types of commercial real estate transactions, including property management and development. Todd now lives in Texas near his grandchildren, and he's obtained a Texas broker's license. He has served on numerous nonprofit boards and was elected and became president of the Newport Mesa Unified School District Board of Ed and Santa Monica Malibu Unified School District Board of Education as well. Todd has been married for 35 years, has 3 children, 2 grandchildren, and resides in New Braunfels, Texas. Well, Todd, thank you very much for offering your time to us today. This is a topic which is clearly of interest to the quantum listing audience, and because they've been signing up in droves, and we're eager to share this with you. And without further ado, I'm going to go over to maybe you can tell us a little bit the agenda for today's webinar.
Thank you. Basically, obviously my bio is a little old. I've been married for almost 48 years.
Wow.
And I've spent 44 years in commercial real estate, which those two things just make me old. That's no qualification. What I want to talk about is something that I've been able to do in my practice very successfully. I've done about $40 million worth of SBA loans and continue to do them. And I found them to be a really good way to generate business. And I'm going to be explaining how all that works. And, kind of our objectives here is you're going to learn about what clients this will work for, the difference between a 504 and a 7A SBA loan, rent versus buy, and how to explain it to your client, how to take ownership in an LLC, and what lenders you should be approaching. And then we'll have some time for some questions at the end. You can go to the next slide. Okay, we're going to walk through these so that, and I'm going to try not to go too fast, but this is an overview. This isn't a specific deal. Who should consider an SBA loan? Anybody that has a license is a candidate for an SBA loan. Doctor, dentist, veterinarian, CPA, appraiser, anybody that has that kind of a practice. And they should not be renting. Basically, they're lighting their money on fire every month. And those professions tend to be stable in their location and not moving from city to city and so forth. So it's important for them to understand that how they can get an SBA loan and what kind of an SBA loan they should get. Another qualification is they can't be a startup. They have to be profitable for 3 years is usually the criteria. This is not set up for startups. The whole idea behind an SBA loan is to create jobs. And what they're trying to do is underwrite small businesses so they can grow and generate more jobs. Why do lenders want to make these loans? Well, it doesn't take rocket science to figure it out. Your local bank has 50% of the loan and in first position. So any bank is happy to make that loan. On a 504, the 40% of the loan is with the SBA, and 50% is with the local bank, and 10% is the down payment that is required. Depending on the type of loan that you're getting, there can be fees and there can be points. And we'll talk about that as we go forward. Most SBA loans have prepayment penalties. And the reason they have prepayment penalties is they're not in the business of real estate speculation. They're in the business of making small businesses grow. And so there's a prepayment penalty for the 40% of the SBA loan, so they can sell it on the secondary market at a fixed return. So on an SBA 504 loan, the prepayment penalties are 10, 9, 8, 7, 6, and for a period of 10 years. So if you want to sell the building or you want to refinance the building, those penalties are in place so that the original loan will return to the investor for what was promised. In a 7A, there's a 3-year prepayment, and we'll talk about that a little bit more. Some borrowers who don't want to have a prepayment for 10 years might choose to do a 7A, but I have to explain to you kind of what the difference is. I have used Chase Bank most of the time on these deals, and the reason is they're a very large bank. They don't do a lot of commercial lending, but they really push SBA. They often don't charge points. They often will pay for the appraisal. And I've been doing this for a long time. And back in the day, and SBA still has a bad reputation because of the fact that people think that it's really a nightmare to go through this process. But with my bank partner, I don't have to do anything. She meets with the client. She gets 3 years P&L, 3 years tax returns, and in a week she can tell the client how much they can borrow. And that's one of the reasons that I use it. But virtually all banks now that do SBA loans, in the past, I had to get all that information and understand it and get it to the bank, and that's no longer the case. All banks, virtually all banks, are anxious to do SBA loans because of the 50% first position. You should always ask what bank your client banks with. That bank already knows your client, already has all that information. And as long as their SBA program is competitive, then you should consider using their bank instead of helping them choose a different bank. Any bank that gives you this loan is going to want to ask for all the accounts. Many small businesses have large revolving values, large deposits, and those large deposits are very valuable to the bank. So, for instance, if you were with Bank of America and you decided to get your SBA loan from Chase Bank, then part of that process is Chase Bank's going to want some of your banking. But that's just, that's not with all banks, but is something that you just need to be flexible about. So can we go to the next slide?
You bet. Here we go.
Now, I don't expect you to read this. I'm sure that this will be available to you. Is that right? You guys
Yes.
be able to give these?
Send out we'll put the slide deck on the page with the replay.
All right, great. So basically what this is doing is talking about a 7A and a 504. A 504 loan is a real estate loan. And you can get a real estate loan, but you can also buy equipment, furniture, trucks, supplies, and those kinds of things that you would need to operate your business in that SBA loan. The difference between the SBA, the 504, and the 7A is this. The 7A is really designed for an equipment purchase. And what they do is they charge you 2 3/4 points on the loan, and the SBA guarantees the loan rather than giving the loan. And that's why there's only a 3-year prepayment. But because of that upfront fee, and also they ask for more equity than just the real estate, it's not for everyone. So the difference between the two loans is one's a real estate loan, one's designed to be an equipment loan, but you can buy real estate with it as well. I've had a couple of doctors that have done a 7A because they wanted to pay their loan off, and they didn't want to be stuck with a prepayment penalty for 10 years. Another client of mine did a 7A because he didn't really want to buy real estate. He wanted to increase the number of trucks he had and some machinery that he needed. So they can be used for both, but primarily the 504 loan is for real estate, and the 7A is for equipment. But they can be used for both under certain circumstances. Can you get the next slide, please?
Got it.
This is further explanation, which you can go through. A couple of advantages with an SBA loan are these. One is you can do a 20 or 25-year amortization, both on your first trust deed and on the second trust deed paid by the SBA. The SBA, this is the big one, SBA will fix the rate of their loan for 20 years, excuse me. So for 20 years, if the interest rate is 5 today, for 20 years, you have that 5% loan. And their interest rates are generally below market, not by 3 points or anything, but they're below market. So the loan looks like a 50% loan from the bank, which generally speaking, they will fix for 10 years with a renegotiation. They'll charge market rate for the loan. And so you might end up with a 5.5 and a 4 3/4. But they'll always give you the combination of what you need. When you have a chance to read this, it's going to tell you that in a 7A, they'll also do 20 to 25 years, but there's a secondary structure where you have to put up more assets to confirm the security for that particular loan. So again, 7A is a little bit more complicated. 504 is very straightforward. Next one, David, please.
All right.
Okay, there's 2 kinds of loans. If you're building brand new and you're going to buy land and build a building, then you can do a 504 SBA loan, but you have to occupy 65% of the property. again, this is to eliminate the speculation portion of it. So, but typically what happens in my situations have been those companies that are borrowing the money to build that building want to have some expansion availability. So they can lease the portion that they're not occupying, and then when that comes available, they can do an expansion if they want to. If you do an SBA loan, I had a client that was wanted to find a dock high door, 12,000 square feet. In our market here in San Antonio, they don't do dock high on small buildings. In the long run, we ended up building a 38,000 square foot building. He occupied 65%. He got a land loan from the SBA and a construction loan from the SBA. Those loans are interest only until about 6 months after you occupy the building. And then the combination loan with the SBA goes into place. The advantage of this is obviously, if you're only occupying 65% of your building, you're going to collect rent from that tenant, and that rent is going to reduce your obligation, which you have to pay each month. This example right now down in yellow, in our market for a brand new office building, it's at least $24 a year, triple net. Well, he's paying $1.24 after the rent from the tenant is reduced, and he's only paying his pro rata share of the triple net expenses. So what that does is in every case, your client will be paying less than they're paying for rent, unless they're going from 50,000 to 25,000 or something like that. But there's a dramatic reduction in the rent. Next one, David.
Okay.
This is if you buy an existing building. It should say 51%. I encourage all of my clients to buy existing buildings because they can borrow money to retrofit the building or do TIs. They can buy the building oftentimes below replacement cost, and they're able to rent out 49% of the building to another tenant. So in this particular example, in the end, after all of the various reductions, my client's going to pay 27 cents a square foot per month for rent. That's his net payment. So I think you can see there's a dramatic advantage with very little risk to using a new building. So I don't know if you guys can see this table very well, but I used 5%, 20-year amortization. The lease rate for the space was $2. We were leasing 5,000 of the 10,000. That generated $10,000 in rent for us, which we reduced from our $20,000 mortgage payment and ended up paying $27 a square foot. Next page, David. Okay, if you're doing a single tenant process, the square footage is the rent is still going to be below what they're paying in rent because the debt service is going to be lower. So in this situation, this client.
Wait, we can't hear you, Todd. Todd, we lost the audio.
A square foot. And again, I want to take you through. They give you the money to buy the land, you put up 10% of that. You get a construction loan, and you don't have to put up 10% of that, and it's interest only. Once the building is completed, about 6 months later, they do the actual loan. So for about 18 to 20 months, you're paying interest only, and you're occupying it for about 6 months of that time. Now, the interest only is added to the loan. So you're not out of pocket except for the 10% during the process of construction. So it's a very advantageous situation. You can continue to pay your rent in your current location without not having a lot of cash flow where you're having to pay the interest on the construction loan during the construction, and you don't have the advantage of occupying the building. Next one, David.
There you
Okay, these are the things that are a little bit more sophisticated, that are things that I really encourage you to do. You should always consult your client's attorney and CPA, particularly the CPA. In virtually all of the deals that I've done, we have formed an LLC, a standalone LLC. The LLC borrows the money. The LLC owns the real estate, and we'll use a doctor as an example. The doctor, let's just say he's paying $4,000 a month in rent, and he's collecting $3,000 a month from the other tenant. But that $4,000 that he pays it from his practice, and he deducts that as an expense. That $4,000 goes into the LLC, and because of depreciation, some of the same money he paid for rent comes back to him tax-free. So obviously the degree of tax-free funds has to do with their tax bracket and what their tax situation is. But in all cases that I've done, there's been an advantage of some of that $4,000 that was his money anyway. He paid into the LLC, and because of depreciation, some of that $4,000 ends up being tax-free to the owner. So that's something that I would always encourage you to do. This is not something that the SBA has a problem with. The local bank is really the one that's doing the security. So it will help you to get your client in the best situation for their circumstances. Another example of this is I ran across some guys that were electricians, and they did new home electric installation. They all had a brand new truck. They had a couple of them had a place on the coast, and they were living high and spending all their money. Well, if they wanted to go to sell their business, and they only just have that lease in place, they're not going to get very much for their business. Let's use another thing. If you're a doctor and you're getting ready to sell your practice and you're renting, let's say you have 3 years left on your lease and you want to sell your practice. Well, that doctor that buys your practice either has to renegotiate that lease or move in 3 years, which depreciates the value of your practice substantially. If you own a building and you want to sell your practice, you can sell the building with it, or you can rent the building to the buyer of your practice. And your client is going to be receiving 30 to 50% more for their practice than they would if they were leasing. Because if the doctor that buys the practice has to move, he's going to lose 40 to 60% of those patients because he hasn't had time to build loyalty with them, and they're used to going to one spot and it's close to their house or whatever. So the advantage of owning is extremely high. And then long term, if you have a business and you want to sell your business, the same thing is true. Same thing is true. Your business is much more valuable if you own the building than if you're renting. And we talked about earlier that, for a lot of professionals, renting is just lighting their money on fire. You get to write off the expense, but if you buy a building, you get to write off that expense as well. And you can determine what that expense is. Next page.
There we go.
Okay, not all banks are the same. Points is points. So a local bank can charge whatever they want, not whatever they want, but they can charge points on their loan. And as I said before, if it's a 7A loan, the SBA is going to charge 2 3/4% points because they're guaranteeing the loan, and it helps them to get their return. Appraisals, every one of you have issues with appraisals these days. I represented my office, which is the largest KW office in the world, and we were going to build a building, and the appraisal came in $1 million less than it was going to cost. And that was because we did some tuck under parking, and the appraiser refused to use it as part of the building. So we went and bought an existing building, a 43,000 square foot office building that was a lender. We gutted it completely. I mean, there was a safe, and there was a drive-through, and there was, a lobby and all of that stuff. We replaced the air conditioning system, put solar on the parking spaces because the SBA requires you to reduce your electricity load on the system to you get a better deal if you with the SBA if you do that. So my client, my owner, we moved in, I don't know, 8 months ago. He's got $5 million in equity. We bought the building and we rehabbed the building, and we had way less in the building than we would have if we'd have built it from the ground up. Environmental. Most banks will ask to do a phase 1, but if it's a bank that does a lot of SBA lending, they're willing to do an environmental report, which is far less expensive. And for instance, Chase Bank didn't charge for it. But you want to be sure that you're not getting into an environmental situation. And the bank wants to make sure that you're not in some kind of environmental situation. So there's 2 levels. There's one where they do an internal review, and the other is where they perform a phase 1. Phase 1 in my market costs about $1,800 to $2,500. And all they're really doing is doing a paper search, going through whatever sites have been reported in the immediate vicinity. That will be your cost, but it will be in your loan. Service. I would encourage you to go to a bank that's aggressive about SBA lending. Bank of America, in my experience, doesn't care. It's just another thing. They got some regional guy doing their SBA. So if it's not an emphasis for that bank, you're not going to get the kind of service that you need. Number 5, I've mentioned already, forms no more. The first SBA loan I did was in Fountain Valley, California. And my client had to put together a 3-ring binder full of information and forms that he had to fill out. I had to walk him through it, make sure we got it all straight. And they asked back then for more security. So he had to pledge he was making eyeglasses. He had to pledge his equipment in order to get the loan. In today's world, that's not the case. The government really wants to get these loans out, and it's very unusual for additional equity to be required, except for in a 7A. And so the SBA people, you'll talk to people, they'll say, "Oh, I hate those SBA loans." Well, they need to meet with my banker for an hour, have their CPA supply some information. A week later, they're going to know how much they can borrow, and we got to find a piece of real estate that fits the criteria. Amortization can be different from the local bank too. Some will amortize for 20 years, but they want it due in 5 for renegotiation, or 7 or 10. Ask that question right away, because the difference between it being renegotiated at 5 and 7 and 10 is a big deal. If it's 10, you know that for those 10 years, you know exactly what your payment's going to be. It's not a variable, it's fixed. And by renegotiation, I should explain that. Basically, if interest rates, when I first started in the business, interest rates were 18, and then they went to 22. So everybody's whining and crying about 5%, and I think it's just silly, because all through my career, I've seen interest rates from 12 to 15, and 5% really is low in the big picture. But it's important that you negotiate, play one lender against the other, so that you can get the best deal for your client. And of course, relationships are always important. You want to find out if your client has a really good relationship with their bank. Make sure that they have a quality CPA that knows when you call them and tell them what you're doing, they know what you're talking about. So those are all pieces of the puzzle as you're going through the process that you need to be aware of. Next slide, please.
Okay.
Now, I've gone through this really quickly, and I'm happy to answer any questions. This was just meant to be introductory, but you got a good basic explanation of how the SBA loans function within your practice. And every client you have that's profitable is a potential client that can use the SBA to finance their business.
That was great. So you have time for some questions, Todd?
Yeah.
Perfect. Well, let me get the ball rolling, and if others would like to ask questions, please unmute yourself or put them in the chat. So my first question is, how long does the SBA loan process take? Is it comparable to getting a regular bank loan, or is it faster, longer?
It's about the same. I usually get a 60-day, I'll do a 30-day contingency for inspection. I'll do a 60-day for financing, and I'll add a couple of extensions, which we pay for, just in case the lender can't meet the deadline.
Is there a minimum and maximum size for the SBA loans?
There's no minimum, there's a maximum. You can only borrow, your 10% can't be more than 10 million. So if you can do 5 loans, as long as it doesn't, your contribution is not more than 10 million. For instance, my client that I sold the building to, they had an SBA loan to buy out their partner. And then they got an SBA loan for the building we bought, and he had to pay off the partner before we could get that loan. And so even though, our all-in cost is probably $11 million, he just has put in $1.1 million. So he's got another $9 million or $8.9 million that he can borrow.
And is the SBA looking for a personal guarantee on SBA loans?
They will ask for a personal guarantee of sorts on a 7A. On a 504, the real estate is the security. Now, if the local bank doesn't feel good about your income or has concerns about your ability to pay, they can ask for a personal guarantee, but to my knowledge, the SBA does not.
Okay. And can you assign SBA loans if you're selling before the 10 years is up?
Yes, it usually costs a point, but you have to be about 5 years in before it makes much sense, because the prepayment penalty doesn't go away.
And what about, are there any incentives to do these types of transactions in opportunity zones?
Well, I think that the bank and the SBA would be more inclined to make a loan in that situation. The other thing that I didn't mention that I just thought of, David, is that let's say you got this loan and you want to pay the loan down. You can pay 20% more than your debt service every year without triggering the prepayment penalty.
Huh, that's good. So it's really interesting. So I don't want to be the question hog. Is anybody else have some questions that they'd like to ask Todd? Uh, don't be shy. I know commercial real estate brokers like to give the impression that they know everything, but this is certainly something that's new to me. So I encourage you to ask your questions while we've got an expert here with us. Um, and, and how many transactions do you think you've done now with these SBA loans, Todd?
Well, it's total of 40 million, but I would say maybe 40.
Wow, interesting. And
Not 40, 20. 20.
and do you?
I think they've averaged about 2 million.
And are your colleagues at KW Commercial, are they saying, "Hey Todd, I've got this. You want to interested in helping me out with it?"
Well, I'm in an unusual situation. I have 1,400 residential agents referring me business because I'm in this large office. There's 11 of us that do commercial. I wouldn't say that they are as well versed in this as I am, but they're aware of it. I've paid $750,000 in referral fees. I just wrote a check for $45,000 referral fee.
That's pretty remarkable. Yeah, I guess better to share the pie than to share the pie than have no pie at all. So.
Well, I don't have to generate, I don't have to cold call. I don't have to generate any business. I have my return customers, and then I have referrals all the time. And the example of this referral was, it was an agent that I did not know in our office. She sold a house to a father, and he mentioned that he was moving his whole family from Texas from California because he didn't like California politics. And he also mentioned that he happened to be in a $35 million 1031 exchange.
Yeah.
And I was able to capture half of that. And that's where that revenue came from. So she got 20% of what I made, and was a pretty happy camper.
Oh, that's great. It's really interesting, and this is definitely a new topic for me, and I'm sure everybody else here today has learned a lot. It's a lot to absorb. As I mentioned before, we will be sending out a link to the replay, and you'll be able to download the document that Todd used here today as part of that. His contact information is going to be in that, but if you can't wait till that, you can reach him on his phone, which is 830-660-0999. And this was fantastic. One last call for any questions. We do have a LC who said thank you, and I join LC in saying thank you. I also want to thank Julia, who helped put this together, and this was really very educational and eye-opening. So I really appreciate this. It's nice to have a new tool that we didn't have to pay for, that we can use to generate business. That's excellent. So thank you, Todd. And I'm going to stop recording, but if you can hang around for another couple of minutes and see if anybody wants to ask questions beyond that, please do. But thanks everybody for your time, and hope to see you on quantum listing webinars in the future.